I'm Keith McCullough, and welcome back to another Real Conversation with my friend Raoul Paul. He's the visionary. He's the fearless leader of Real Vision. It's probably the best guy, or at least one of them, Raoul. Certainly the guy with the best view where he's sitting today that can think clearly about what is happening in the market today. I think a lot of people, maybe not a lot of people that follow both of us, but a lot of people elsewhere have been surprised by the move in bond yields in particular and the abrupt move across asset classes. So we tried to time it this way, did we not, Raoul? We tried to time
Exactly. We knew the markets were going to set up like this perfectly for our conversation.
Timely, topical content is what we're and it truly is what we're after, and we're trying to get people readily aware of the risks. So I want to start with that. I know you haven't been shy about it, and thankfully you've absolutely nailed a massive call, whether it's in euro dollars or some of the things that I just mentioned. But you've not been shy in talking about recessionary risks, and I just want to lay that out there first and just give you the opening volley.
Yeah, I mean, look, like you, I don't deal in certainties, I deal in probabilities, but I use a business cycle framework as my format for analysis and understanding where we are in the world. And if I look at the business cycle, and I can use, let's say, ISM as an easy way of looking at it, and I look at a bunch of forward-looking indicators, now that could be stuff like semiconductor sales, or it may be global trade, or it may be exports, or it may be, there's a number of things that are part of that business cycle. And many of those are starting to flash signals to say, if we continue in this trend, then we're going into recession, and we could be there maybe end of this year, maybe beginning of next year. So I'm starting to really focus on this whole process. And obviously the bond market's telling us something very similar as well. So I always pay attention to the bond market. So that's kind of my thesis is in that. It's in the data and my particular analysis framework.
Mm-hmm. Well, that analysis lends itself to what's readily available for anybody to look at, which is a recession that's already here. I mean, we have a recession in corporate profits. Depending on what sector, it's getting pretty nasty pretty quickly. We have actually a recession in tech. I mean, the guys can throw up, and pardon the pun, but throwing up is kind of how these people have been trying to throw up these numbers and guidance that people don't believe, and then they're going up on bad news, but then they're not. I mean, tech earnings are actually negative year over year for the second quarter in a row within the S&P 500 as of this morning. So that doesn't look as bad as energy and materials yet, but those are recessionary numbers. I mean, how often do you get pinged on, is that all priced in though, Raoul? I mean, I think I go meeting to meeting, and that's got to be one of the top questions I get.
I don't, because most of what I've been talking about is more forward looking, but I do look at corporate profits, and year on year rate of change of corporate profits is roughly the same as the ISM. They kind of look the same. So this is a function of the business cycle. It's getting weaker, but what gets interesting to me is once these corporate profits start falling and corporate cash flows start falling, then the probabilities of buybacks start falling as well. So the markets themselves become more volatile. Mm-hmm. So there's a whole bunch of things that I look at. People are, in interest rate world, yes, people keep saying, well, isn't it all priced in? Of which my answer is no, rates are going to zero and lower. But in equity markets, I've been less involved in equity markets because I think the higher quality trade that you and I talked about last time we got together was that kind of front end of the curve market, and that that euro dollars in 2 years, because that was just such a layup. It's less volatility involved and high returns. Mm-hmm.
Yeah, that's precisely the point. And I think a lot of people that are watching this now are starting to understand how to do macro the way that you and I do it in rate of change terms is quite that point, which is you don't actually have to take on the volatility of chasing the chart in semiconductors or the NASDAQ for that matter, when you could have just made money all along. We call it full cycle investing. I think I might actually write a book on that because I just don't think that enough people think about the full cycle of investing across the profit cycle and across the entirety of the sine curve.
I think people struggle with also multi-asset stuff. So people have been so focused on equities in the last 8 years or so that they don't realize, people kind of think of bonds as a safe haven. Well, bonds with a bit of leverage, like bond futures, are incredible source of profit. Something like Stan Druckenmiller, when he came on Real Vision, he said, look, the dirty truth is he makes all of his money in the 18 months going into recession, and he makes it all out of Eurodollar futures. Because that's where the massive leverage, but with low volatility, comes from.
Yeah, and some people, I've had a lot of feedback on that comment when you first made it, because of course that was your call. That definitely wasn't the focus of my call. I mean, I was long the short end of the curve, long of the curve, the entirety of the curve. But that point, like some call them, and we have them as individual subscribers, both you and I, they don't know how to implement that trade, Raoul. And I don't want to spend too much time on that. But how would you actually tell your I'm not talking average guy in the street or talk down to people, but somebody that's made a lot of money, but maybe not Goldman's top prime brokerage client.
So
like, how do they do that?
Yeah, and that question comes up. That's the biggest question I get all day is, okay, how do I do this trade? Because people aren't familiar with it.
Yep.
So the simple thing is a euro-dollar futures contract is priced at, let's say, 98.50 right now for the December 2020 euro-dollar future. So what does that mean? Well, basically, 100 minus that number gives you the interest rate that it's pricing in, which is telling you 1.5%. Okay, now I think rates are going to zero, so I've got 1.5% to be made from that. So that doesn't look like a lot, but the fact is that in the futures in these, you only put down relatively little margin, so you can actually make 10x your money in a trade like that. But to make it even easier for somebody who's not sure about that leverage, not sure how to think about it, it's one of the most liquid markets on earth, if not the most liquid futures market on earth, and they have an incredibly liquid options market. So here's a nice easy way of playing it is, if you think that interest rates are going to zero, like me, and you think that's going to happen in the next 18 months, then you can buy the December 99 strike calls on Eurodollars for 2020, and they cost about, I think the last time I checked, about 16 ticks, and you can make back 100. So there's a nice kind of 5-for-1 risk reward in that. So that's a very simple way. You're not running excess risks, but you've got huge returns if you believe, as in my kind of thesis, that rates are going to zero.
Yeah, massive returns this week, and in one day, massive returns. No wonder why you get such a nice smile on your face this week. And that's really when you move the move, and a lot of people have had questions about that, moving the Treasury bond volatility index. People thought that was going to happen when interest rates were going up. Oh my God, this is the risk. When in reality, it's actually blowing a hole through the bottom end of what we call the risk range in both the 10-year, the 2-year, et cetera. What is it about that people don't quite get in the moment when you're at this stage of the cycle?
I think because structurally, it's a big shift to go from people getting their head around interest rates are not rising, because the world sets itself up for this. Mortgages, everyone starts having fixed rate mortgages, everything starts setting up that's embedded within the derivative markets of this. So what you set up is negative gamma, which is things move faster to the downside than to the upside in terms of yield because of this structural setup. So that's why when everybody was betting on the rates are going to 4%, 5%, 6%, all that nonsense that went on, I kind of knew, and you knew as well, is that the actual fast rate of change was when that view was wrong, because the market was entirely set up for it. So even when we look at positioning in bond markets right now, they still haven't priced that in. So I think that all of that negative gamma is in yields falling or the TLT rising.
Yeah, that's a super important point, as many of the points that you make are, because you're looking at within the lens of not just stocks. I mean, I hate that increasingly hate that term, but it is at least moderately funny. Guys, if you show CFTC futures and options positioning, the non-commercial RAL is what I'm going to show here. You can't see it, but you obviously look at this and look at it.
I can see, yeah.
And look, you can see it.
Yeah.
Okay, so still today, in October, that was the max net long or max net short position, 2s, 5s, 10s, pick your vintage. And people say, well, that's come in. Well, no, I mean that if it was a consensus would be a net long position. It's still a massive net short position on a nominal basis, and for whatever reason, that just has not gone away. Do you have any thoughts on that?
I don't understand why it's not gone away. We've noticed that in a few markets recently, but in the Eurodollar markets, the one that I've been looking at the most, I mean, it was a negative. I mean, people were short 4 million contracts. It was the largest position in the history of Eurodollars when I started going the other way.
Yep.
And now they've just gone positive, and people are saying, oh my God, they're overbought. I'm like, well, if they went negative 4 million, they're going to go positive 4 million too. So I just think we've got a huge move still to come. And I understand that the pension system is still dramatically underweight fixed income, and as are almost all portfolios. So I think there's a long, long, long way before we get there.
Yeah, that's precisely the point that we just made, and it's again, I don't want to sound Trumpian with the super duper awesomely important point, but the point actually is the point. When you look at the hedge fund community and non-commercial positioning across macro, there is a mean reverting nature to consensus. So the consensus of -3 to 4 million Eurodollar contracts, which people could see again, show that data, guys. That was within on a 1-year look back the low. Now we're not even at 1 million net long. So we'd like to talk about the standard deviation of risk, or the Z-score of the positioning relative to itself, because that really is a way to look at, as opposed to feeling. And I'm sure you get this a lot, Raoul. I mean, people tell me how they feel about the market. I mean, enough about your feelings. This isn't about feel. This is what the positioning is, and that's I think a real important thing that I've had to learn over the course of certainly the last 5 to 10 years, never mind the last 20.
Yeah, and it's learning to interpret that data properly without putting your structural biases into it. So people really struggle with that, and I think it does take time to learn, and it does take time to really not listen to your inner voice and actually just look at the data properly and understand what it's saying.
Yeah, you can take and again, just like you said, ISMs, PMIs, the rate of change data in the business cycle, you could take the rate of change in positioning, whether you're looking at options, premiums, or discounts. You can look at, as we just outlined, the net positioning of the market.
And that's key, I think, Keith, is the rate of change is everything in macro. Everything happens at the margin. So it's that we're always looking for, and understanding those shifts of the rate of change, because once it actually shows up in price, it's too late.
Yeah, exactly. Now, one thing that obviously annoys me, because I don't start with valuation, is now we have a bunch of people that are playing catch up to this view that growth is slowing, and they have these magical optimal PE models that tell you that what the certain PE will be of the S&P at certain levels of the ISM. I mean, I couldn't make that up if I tried. So I'll let them keep making that up. But even if people want to still do macro that way, if they still want to live in their linear PE boxes and valuation frameworks, what is it about ISMs that doesn't stop them from going down? Because a lot of people now would just say, "Hey, Raoul, great call, but ISMs can't go any lower." Like, why do you think that can continue?
The reason being is we're now in the longest cycle in all recorded US history. So it's already very long in the tooth. The structure of the cycle looks negative. Now, people say, yeah, but so did it in 2015 and so did it in 2013. So let's 12. So let's deal with those two examples. 2012, when US GDP growth hit 0, was Europe almost fell apart. So we came to an extraordinary stress situation. We had a bear market around the world, and we thought the entire European banking system, and in fact the euro itself, was going to go. Okay, so that's a pretty valid reason. The US, there was a massive QE, everybody was stimulating, everybody was trying to avoid the bankruptcy of the entire world's financial system. Okay, they saved it, great. The next one was 2015, when the dollar exploded higher, and the whole world went into slowdown as oil prices collapsed, commodity prices collapsed, and global dollar flows shrunk. So that was a situation that was a global issue. It spread to the US manufacturing, and it didn't quite make it through. The Chinese ended up stimulating just in time to save the day. Now, the Fed weren't cutting rates then, weren't hiking rates then. The rate hike cycle hadn't started. So normally, the probability is if the Fed have been hiking rates for a while, you tend to end the business cycle then, and only then. So cut to 2018, China had started slowing and the Fed were hiking rates. It was that dichotomy that made me realize something was potentially going wrong here, that the globe was slowing. So China, Asia, Europe were all starting to slow, and meanwhile the Fed were hiking. And I thought, the Fed are going to lag this cycle and they're going to get themselves into trouble. And then I started to see the economic data, the rate of change of that economic data start falling. So I think now we've had a situation where rates are tight. They've moved 25 basis points. We have a situation where tariffs are imposing a slowdown in global trade. All of the global trade supply linkages are breaking, and corporations are paralyzed in what they can do in terms of rebuilding trade linkages. It's difficult to know. you start thinking, I'm going to move to Vietnam. Next minute, Trump stops Vietnam as your avenue. Mexico, it's like on, off, on, off. So do I want to manufacture in Mexico? I don't, because I don't know what the outcomes are going to be. So if you've got an unknown policy, you have a tendency to just say, right, I'm going to go and analyze my trade linkages, employ McKinsey and KPMG and figure this out over the next 3 years, but I'm not spending money. So corporate expenditure collapses in that environment. So I think there is a probability to that too. We're seeing global trade falling, and then we've got the dollar, which is, you can't keep it down. And if that goes higher, so we're starting to shift all the balance of probabilities in for a lower ISM. And then the final part of this equation, or not the final part, we've obviously got China slowing down, Europe slowing down. There's no monetary policy left in any of these countries, so that makes it difficult to stop. Nobody's going to stimulate yet. So, and then on top of that, we've got the Treasury running, increasing its Treasury general account as the debt ceiling raises, and that in itself is causing another dollar shortage and a tightening of money market conditions just when they don't want conditions to tighten.
That's so to put all that and wrap it with a bow in my vernacular, in rate of change space, you don't think that even though that we've seen weakening since Q1 of 18 in China, EM, Europe, et cetera, that they can comp easier comps just because they're a little bit easier? They're not absolutely recessionary easy comps. They're just easier than where they came from, which is from the peak of the cycle.
We're just marginal recessions everywhere, in all of those regions, right? So we haven't had the flush, and the flush is always, you need to get worried once everything goes to a correlation of 1, and the stocks all start selling off globally, bond markets scream higher, all of those kind of things. When they all happen together for an extended period of time, and GDP growth around the world, you start seeing the negative 1s, negative 2s. After that, you start paying attention for the rate of growth, and I start going down to 3-month on 3-month rate of change just to make sure I don't miss that turning point and get carried out. But we haven't got there yet. So we had a little bit of a pause over a couple of the summer months, but the forward-looking data looks terrible still. So it looks to me like we're about to break lower in all of these all of the data. And I think, let's wait and see how your nowcast does, but it'll be very interesting to see whether that starts drifting lower as well.
Well, the way that the model works, and we've walked through it, is that easy comps beget a higher probability or a rising probability that the former slowdown, in this case, starts to slow A at a lesser rate, and then B, you get an acceleration. We've seen neither. In fact, we've seen against easier comps, you take any Asian export data, they are some of the worst numbers, Raoul. I've been writing these numbers down. I also write them down. We obviously pop them in the predictive tracking algos, but I write them down. I've never written down negative 38% year-over-year Japanese machine tool orders. I mean, these are like the worst numbers I've ever seen. And now they're starting to find their way into like the main line of France consumer spending went negative 0.6 year over year this week. German consumption or retail sales negative. So you have the exporting consumers in Europe are probably getting a little alarmed by the export data by which they own the businesses, and they're spending less money too. So I can't find a green shoot. I just can't. There's zero.
No, and I took off a whole bunch of trades in June, fearing some sort of bounce as some stability. And I've been waiting for some improvement in the data. The best we got was a bit of sideways.
Yeah.
And I cannot find a green shoot. And I sat down to write Global Macro Investor, which is my kind of big research product that I've been writing for the last 15 years. I sat down and wrote that last weekend. And I didn't know what I was going to write. I thought I may continue with the I'm not really sure. I didn't have clarity. And I sat down and did all of my analysis, looked at all of my data, looked at all of my charts, and I'm like, holy shit, this is going to hell in a handbasket.
It really is holy shit. I mean, I think you said the other day, what did you say about the shit the other day on Twitter?
Yeah, there's a shit ton going on right now.
Yeah, there is. And I think that, because a lot of what we've just talked about has to do with that global cyclical slowdown, and so many macro tourists think it has to do with the tariffs and the trade speak, but it really is comping the most epic stimulus in the history of China. That's why you were slowing to begin with. And then moreover, which I think is the most complacent point, is that people don't understand, to your point, how intensely positive the rate of change was in the US at the very end of it, which was at this time last year. We have a slide on that just to show you in context, slide 66, which is the consecutiveness of the momentum of growth. 9 quarters in a row. Never happened in the history of the USA. That 8 should be a 9. And at the end of the day, like, people are asking you about 2016. I mean, 2016 was the beginning of that. I mean, the back end, the acceleration coming out of the Chinese stimulus wasn't, Trump's big brain in the election. It was easy comparisons. And now we have these, what I would just call uncomparable comps in the place that the most amount of people are the most complacent, which is basically U.S. equities.
Yeah, that's right. And really interesting. On Real Vision, I had 2 weeks of programming where I put in my hypothesis that I think we're going into recession, and I tested against everybody I knew. It was, I tried to get you, but you were away. We got everybody that I really respected to talk about it, and fascinating because we dug into various sectors and different regions to get different perspectives. I mean, things I didn't know about what's happening, for example, to the Japanese regional banks and how they're imploding because of negative rates, and what's happening to obviously the European banks and how they're struggling with negative rates, and a whole bunch of things out there. Mm-hmm. It is we even talked to people who are shipping metals around the world to find out what's going on with those markets, and I could not find a green shoot from anybody in anything, and the rate of change for everybody looks like it's getting worse. And
perversely, if you do get a green shoot, now that we have I have no idea what Powell was doing, calling it a mid-cycle adjustment. Lo and behold, you get a reasonably good or a late cycle good, which always happens, employment report today, and the market's like, oh my God, any good data point, never mind a great one, or a green shoot would be bad for the market. So that's a Wally world for people. They don't know what to do with that. Yeah, clearly the equity market today, I mean, this is a multi-standard deviation move after 48 hours of multi-standard deviation moves. And those kind of pulverizing moves tell you that your average long short or long only portfolio manager was improperly positioned for this and now really doesn't have a catalyst. There's no Fed cut for at least another month, and there's definitely no solution to the trade war. So what do they do with that?
And look, and also you and I know is Fed cuts are usually terrible because they're going on when the economy is weakening.
Yes.
They're never bullish equities. The first cut often is because everyone gets excited about the first cut. But after a while, you very quickly realize that when the Fed are cutting rates, the stock market is falling and the economy is slowing. And people's mindsets really screwy about this. I don't really quite understand that.
Well, the old wall does a pretty good job saying it's different this time. I mean, that's what their research departments have said. Hey, as long as you don't have a recession, it's okay, which is just not true. I mean, you don't have to have a recession to lose 30, 40, 50% of your money. We didn't have a recession in the U.S. in 2016. The average decline in the Russell 3000 was 38% from the 2015 high. But what happened was you had a profit recession in certain parts of the economy.
Yeah, and you and I were talking before we came on the show is that the tag recession is irrelevant, right? Because we're in the business of trying to make money out of markets, or even if not, help people who run businesses understand the risks or the opportunities within the global economy. It's irrelevant whether it's a recession or not. What we're trying to say is, okay, growth is slowing down here, growth is speeding up here. This is how you can take advantage of it, or this is how you can protect yourself. And the tag of recession is kind of all a bit ludicrous, if I believe we're going into recession or not. Yeah. No, what I believe in is bond yields are going much lower. Equities are probably volatile, maybe go lower, but I have a stronger view on commodities and a stronger view on the dollar. That's my view. It just happens to sound like a recession, so I'll go with that because I think it's probably correct, but it doesn't really matter.
No, but that's really that tagging. People want to label people, but they want to simplify it. They don't want to do all the work. I mean, I was in Greenwich yesterday. We had seeing clients of one big insurance company, and so they weren't into the he said, she said of Wall Street, but 2 hedge funds, Raoul, said, oh, you're doing a thing with that recession guy. So they're calling you the recession guy. And I'm like, he's a business cycle guy. He's a macro guy, but I hear you. It's interesting at this stage that most of the bears have gone away. That is, by the way, I think a compliment to you. But labeling you that barely grazes across the beginning of the points that we're trying to make, does it not?
Yeah, exactly. It's ridiculous, right? You and I are indifferent to where we are. I come at my analysis in a different way than you because I look at the cycle and I project the cycle forwards. You're using it from your data set that you use. But the point being is some markets we're looking at the optimum, a more optimistic opportunity. I'm not seeing it right now around the world, but I'm indifferent to where it goes. Yes, look, I'm a macro guy. I came from a hedge fund. I know that you make all the money in a bear market. I get that. But that doesn't necessarily mean that it makes me overwhelmingly bearish in everything I look at. It's irrelevant to me. What we're here to do is make money.
Yeah, well, I mean, you couldn't find somebody who's more bullish on treasuries or sovereign bonds, for that matter, than
that's right.
than you or I.
What's wrong with being bullish on bonds, right?
I mean, I have struggled, and some people struggle with me because I struggle with it by just calling out guys like Gunlock on this point. I mean, we're talking some, I would say, at least if my name was the Bond King, I think I'd be relatively disappointed in my performance in saying that, 10 months ago that the bond yields could only go up, and then the whole way down. He actually at one point tweeted, those who are buying treasuries here, I think around like maybe even 2.25, 250 on the 10-year, would feel quote unquote remorse. And then he just went away on it. I'm wondering, like, where is everyone on this? Why have I would say that he's a pretty big player in the market, would you not? And that's a pretty big offsides if that is.
I think there's something bigger than that. Is nobody cares about bonds. Everyone's been brainwashed. That it's equity or nothing.
Yeah, that's why there's only one Bond King left.
Yeah, and the fact is, as you know, is you can make a lot of money in bonds.
Yeah.
And everyone's so brainwashed by equities, and so they ignore that Gunlock made such a bad call because there's no vigilantes over people like him anymore. Because it's all equity guys.
And he's been fantastic over the course of his career. It doesn't mean that people can start to lose money. That's happened, by the way, to every major money manager across history that gets too big. So anyway, I digress. Back on the dollar, and then I want to hit on some of your other ideas that have been not only differentiated, but I think need to get dug into a little deeper here. Dollars. Dollar from here, I mean, first of all, quad 4, as we call it, is bullish for the dollar. It's the only economic quadrant, where the dollar back tests as having its highest, a positive expected value, never mind a high and rising one. So we're in that. When the dollar is going up and treasury yields are going down, you're quintessentially the market, global macro market, not semiconductor chart monkey market, is saying, look, we're in quad 4. How hard would it be? People today are saying, well, Trump's going to turn around and do something like a la Baker 1980s to the dollar because Powell can't get it done. And I'm like, oh, that sounds interesting. Like most things you might want to read on Zero Hedge, but that'd be hard to do against what the euro's doing and everything else. The British pound in particular.
Look, firstly, if you're imposing trade tariffs, you're lowering global trade. That's happening. So that automatically means there are less US dollars in the global system.
Yep.
If there's less dollars and the world is short, according to the BIS, 13 trillion US dollars, that's foreigners have dollar denominated debts, then you've got a problem. So how do the Fed, with their crappy 2% interest rate ability, change that equation? They simply cannot. So nothing in the interest rate horizon is going to change that. Okay, so then we talk about intervention. That's the new flavor of the month. Everyone's like, oh, the Fed are going to intervene. Sure. Okay. Problem is Japan and Europe are doing the same thing. Mm-hmm. They're wanting their currencies to depreciate. It's one of the reasons I'm bullish on gold, and one of the reasons I'm bullish on Bitcoin, actually. But anyway, the situation is it's virtually impossible for the US to run its policies, its foreign policy, and have a weak dollar. So it's going to have to figure out some answer here, but it's not going to be this. So I think that it's going to become a much bigger problem than anybody even perceives, because the two things are mutually exclusive. Mm-hmm. So I don't think there's anything they can do about it unless they completely back away from their foreign policy, which they can't do because that's what they're going to use to run the election on.
It's a frightening path that they might have to go down. Now, somebody might say, okay, election coming up, that actually is the point, that you'd have to just get outright structurally aggressive against the dollar, cut 50 basis points at a time, 3 times for starters, and then go to MMT. I think MMT is a credible threat for the world's reserve currency if it's used and abused to that degree. What do you think about that?
Yeah, I agree. So firstly, I think why would Trump want a weaker dollar going into the election? The reason you want a strong dollar is because you tell any American your dollar's strong, it sounds good, right? You're doing the right thing. Like the stock market's going up. The other thing is that it offsets any increase in cost due to tariffs. So that's what it's doing. So the consumer doesn't feel it as much. So I don't think there's a real issue with a strong dollar going into the election. And he can say, look what these other countries are doing to us, and it just plays into that election base. So I don't really know from that. I just see the fact that I can't see how they can stop it. MMT. Well, if the Fed are doing MMT, what the hell are the Japanese doing? They're probably going to debt jubilee. What are the Europeans doing, right? They've all run out. So I hosted a Goldman macro event in London a couple of months ago, and I invited the ECB because I said, I want to get them in a room and say, right, so what are you going to do next time? Because we're about to come into recession. What are you going to do? And they said, well, we might cut rates a bit more. I said, what, 20 bips, 50 bips? What are you going to do? And they didn't have an answer. Their answer is Christine Lagarde.
Yeah. Oh yeah.
She does restructurings of bankrupt nations.
Lovely. And I'm sure she's lovely. Next idea that you've had, European banks. Let's just dig into that. And also, let's just tie it to reality. I mean, and maybe is that the end of the U.S. bank story too? I hear a lot of value guys and gals pitching me bank stocks. They actually all used to pitch European bank stocks. If you remember, that was the best hedge fund idea back in 2017. They're all cheap relative to U.S. banks. And they completely missed the cycle call in Europe and interest rates going to all-time lows. I think that was a bit of a problem. But I mean, from here, because they've gone down a lot, which has been a great call for you, for Dalio, for many of us who've been bearish on Europe and their banks. Why would they go lower from here?
Well, I don't know if you can see behind me on my screen I'm looking at the European bank sector. We're on something, I call it the GMI worst chart in the world. It's on a 40-year, a 35-year trend line, which is a kind of a head and shoulders top. And we're just about to break. So what the hell's going on in European banks? Well, I lived in Europe for 10 years, living on the Mediterranean coast in Spain. I almost saw the banking system close down. The ECB forced the Spanish banks to take a bailout. What actually happens is the European banks never solved their debt problems, for starters. Then interest rates went negative and all the banks' margins got crushed. So they've got toxic assets, too much lending still, too many NPLs that are not disclosed, and they fund in US dollars, half of their funding book. There's not enough dollars around. So they have a real problem. So I'm watching the smaller Spanish banks like Banco Sabadell, even the big ones like BBVA, Sabadell, new all-time lows. Bankia, new all-time lows. Sabadell's now trading at like 70 cents, euro cents.
That's
these things are going under. And we know about Deutsche Bank. I've been on and on and on about Deutsche Bank. And then there's SocGen, there's UBS, there's Credit Suisse. The whole lot look like they're going down the toilet. And the worst thing about this is, what is the central bank's response? Cut rates. So the bunds are going massively negative. What does that do? That pushes the banks into the death spiral. So we've got ourselves in a spiral now where nobody has an outcome that can save the banks. Because they're now saying, the ECB are now saying, well, maybe they'll do a tiered negative rate system so it doesn't hurt the banks as much. Problem is the bunds, which are freely traded, are going to go massive negative. So then the ECB are going to have to peg the bund market as well. It's a mess. And I don't think they've got the time to resolve it before, I think Christine Lagarde is going to come into her new job and have to negotiate a massive bailout of the European banking sector.
I mean, that looks, one of the first lessons I was ever taught as a hedge fund analyst, when I was the analyst and the PM was yelling at me, was lower lows are bad. Lower lows are bad. Like, what are you, an idiot, Keith? And I was like, okay, I got it. Lower lows are bad. Higher highs are good. But lower lows, when you pull out a 20-year chart, a 30-year chart, and you're making lower lows on that basis, Japanese banks, I guess, if you pulled it back the 35-year chart, would probably look quite similar, would they not?
Yeah, so I wrote about the Japanese banks. The Japanese banks also are breaking to new all-time lows, particularly the regional bank.
Yeah.
So, and nobody's listening, Keith.
Yeah, but
Keith, if we went on television in the last recession, say every single major bank in Japan and Europe is going to all-time lows, there'd be chaos. Now everyone's like, so what? It's cheap.
What you don't understand, Raoul, is that they're incredibly cheap. It's the valuation that I have of my book value valuation, my super duper Harvard Business School education tells me I have to buy Bank of America with both hands here because there's no way it can get any cheaper. And we're going to adopt the same damn monetary policy that they have. I mean, with no yield curve. The amount of people, by the way, now that I'm going to rant a little bit, that told me, hedge fund clients told me, so they were telling me in good faith and going to still pay me because I disagreed, was that when the Fed cuts, Keith, the curve's finally going to steepen and it's going to be good for the banks. And what happened? Fed cut rates, the curve gets pancaked. We got inversion again this morning, and people are still long U.S. bank stocks because they're cheap.
Also, if rates are going to zero, the curve can steepen, but the banks are going to zero, and that's the case.
Yeah.
So there is, we've seen this in Europe and Japan. Yes, the curve can never steepen as much as it ever did in the past, obviously, because as rates all come down to zero. But the fact is for the banks, that is the worst situation. It's not like you've got 10s trading at 6% and 2s trading at 2%. You've got 2s at -2 and 10s at negative 75 basis points. I mean, that's the death of the banking system.
Yeah, that's why Deutsche Bank just eliminated all of our competition at 5% market share for Raoul and Keith. No more research because they can't pay for it. You can't pay for anything with that level. That's where the level of rates actually does come into play. So I got that. Now on South Korea, that's one. I want to get to the questions. By the way, if you have questions for Raoul or I, please pop them in the queue. There's already a ton of them. I'm going to have to sift through them. But South Korea has become a quite interesting. I think we have a chart. Do we have a chart of the Kospi? I mean, if anybody doesn't know where it is, they probably haven't been doing macro. But I mean, Dr. Copper, Dr. Kospi, what could possibly go wrong? They're all making new 2-year lows in the middle of an alleged trade deal, I might add. But what is what is the broader picture in South Korea right now to consider?
You and I love a canary in the coal mine, right? Something that reflects all of our views perfectly. And Korea is that, because here is a country with virtually no interest rates left, massive debts, that got caught up in global trade wars, the global semiconductor wipeout that's going on. They are part of the supply chain with China, so that's a big mess. Then, on top of it, the Japanese started a trade war with them, so they're trying to stop doing trade. And South Korea is only an export nation. So it is struggling from every single angle, and then their corporate sector massively funds in US dollars, and the dollar goes up. So what you've got is a perfect storm for South Korea, and also China itself, the economy's slow, and there's a risk that the Chinese tanks go into Hong Kong. So just as a regional thing, this is a big concern all round for Korea. So Korea, I think, stands a chance to see capital flight. And if I look at the monthly, daily, and weekly charts of the currency, it looks like that currency is moving. If we look at any of the economic data, the rate of change of all of it is falling. It's in free fall right now. As you said, stuff like exports, we don't see numbers like this often. So it is a perfect storm going on for South Korea, and I think it's only just started, because you can see from the Kospi, we haven't really started breaking down yet, because when this market breaks, it really breaks. And what I love about South Korea is it has a lot of gamma to it. So that means you can buy some puts and you'll make money very quickly if you get it right. And the currency, when it moves, really moves. So that's what I think is going on there. And I don't think anybody's paying attention. In fact, there's too much going on in global macro that people just cannot physically keep on top of all of the moving parts.
Well, because the essence of macro tourism is that you're bouncing from headline to headline as opposed to paying attention to time series within 10, 20, and 30-year charts. That's right. Quintessentially why we're different. I mean,
how all the assets fit into that, right. The narratives that all the data is telling you, and that's why it is different, because we don't follow the headlines. You're trying to anticipate the headlines by looking at the data and understanding the rate of change and all the things you talk about, and that's the crucial thing here. I happen to love the charts. I'm a technical analyst on top of that, because I think it helps give me some sort of understanding of probabilities as well.
100%. I mean, 100%. I'm 100% certain that 80% of the world looked like hell before Trump tweeted one thing this week. And that's just a fact. I mean, you didn't have to know anything. I was joking in a meeting. I was like, even if I was his BFF and the guy texted me that he was going to tweet that, which would obviously be illegal, but even if I would have already been positioned, I wouldn't have had to change my position. Since the alleged progress in the deal, or 90% of the deal done, All these things have been happening. Like you said, I mean, earlier this week, South Korean industrial production growth was down 2.9 year over year. If we had that number, anywhere close to that number in the U.S., people would have their hair on fire. I mean, they wouldn't be worried about, well, the company didn't guide down enough. They just wouldn't believe the guidance.
But that's an interesting thing to explore, Keith, because that makes me worried. It probably makes you worried at the back of your mind, is that the investor psychology in the US is kind of thinking that it's bulletproof, while you and I, being macro guys, are looking at the world basically in meltdown and saying, we know that macro is contagious. And so the probability of the US not going into meltdown 2 is relatively low. Now, whether that comes into a recession or whatever, it doesn't really matter. But what are the chances that the equity market could have a big problem here, or the bond market screams high? You know, all of those things. People, the US investors don't see it yet. But I'm looking at what's going on around the world, and I'm like, oh my God, this is a really concerning environment. This is one of the more concerning environments I've seen in the global picture.
Yeah, it's absolutely true. Let's. I'm going to get to some questions here, Raoul, because there's some very good ones here, and keep them coming. Raoul, in the Great Recession, the ECB and Treasury swapped billions because the ECB was out of dollars. Why wouldn't they do this again to avoid what Raoul just said about Spanish banks being short dollars?
There is something, and I don't fully understand this, but I've asked people who are deep in the plumbing, and there's something now to do with the Basel III regulations and the Dodd-Frank, that different entities have to fund themselves in different ways. So swap lines with the central banks is not the answer. I wish I knew the full answer and why that's not the case, but people tell me it can't really be done in the same way, and you can't take up the swap lines.
It is interesting, though, that generally speaking, I think it's a generalization, but it is accurate. Anytime you're accurately depicting the cycle, God forbid the cycle, in a way that the bull can't defend it, they always go to a thing that a central planner can do to fix it.
Always.
Always. And there's always more. And this time will not be different. But I do appreciate that question, because they did do that. So,
Right.
you know.
But it didn't stop the dollar going up over that period, and they didn't stop funding issues either. So, you know, we have to realize that it's not the panacea. It's not going to solve everything.
Do you think that, and this has been asked a couple times, I've actually not been asked this, but I guess because Trump's doing it, he's going to make Powell his fall guy. Do you think that in the end, the central bankers themselves end up being all of the fall guys?
Yes. I think, well, it's very easy, right, to blame the central bank. Again, if we're playing a game of politics to get voted in, he set Powell up as the fall guy.
Yeah.
So it's pretty straightforward. So Trump or any of the politicians can blame the central banks as the key issue here, even though it's not them. They're a reactive function, as you know. They don't really change. They don't set the trend. They react to it.
Right. I mean, it's also interesting. I mean, there's another question about this relative to Deutsche Bank, but I'll just ask my own question because I don't know what the answer is. But I've always thought of Bernanke as his job was to protect the house, protect the banks. Now I got P.E. Powell. I basically call him that because I think he's trying to protect credit spreads and private equity and corporates. But your European central banker, don't they still have to protect the house and be like Bernanke and protect Deutsche Bank? Do they have the liquidity? Do they have the ability to actually fully do that, like we did with Lehman Brothers?
No,
or not
because they have one mandate, which is inflation. So it is very difficult for them to do that. This is why I've mentioned a couple of times on this conversation is Christine Lagarde is really important. Why she's been brought in is because they know that this is going to require political solution, and Europe is difficult to do because you've got to deal with all of these nations. So you're going to have to change laws. You're going to have to change deficit laws because you need fiscal stimulus to somehow deal with this. Somehow you're going to have to find some economic solution. So it's a really complicated situation in Europe in how to deal with this. It's not straightforward.
Not at all. Not at all. Here's a question which I won't mince words. I appreciate it. You and I can do this because we keep it real and real vision and in a real conversation. Why do some of these bullish clowns think it's 1995, Raoul?
Because it's the last hope. That was the only other time that we had a mid-cycle slowdown. Now, that's the only time we went through a rate cycle where it wasn't a recession.
Yeah.
So, of course, it's sad to see people pin their hopes on one thing. on the lowest probability odds and just pray that it works. But okay, I get it.
Well, I mean, it's actually, why don't some of the bears that could be a lot more bearish think that this is a lot more like 1999, 2000? There's so many similarities when it comes. I mean, credit, for example, tech has never been the largest percentage of credit going all the way back to then, and obviously back then, telecom. Tom Lee was a telecom analyst, but I mean, you got like the whole world changed in a hurry when those earnings. And this is why I'm quite concerned about tech earnings are negative year over year. And people go, but that's because of the semis. I'm like, McFly, I mean, that's a big part of tech. I mean, and it's a big part of South Korea, it's a big part of everything else. Also, corporate credit, as a percentage of GDP has never been as procyclically large going all the way back to 2000, when all those growth rates, the earnings growth rate itself, the actual base of earnings by which credit is marketed on and capital raised. Why isn't it 1999, 2000? I mean, we see plenty of cloud stocks trade at 15 to 20, 30 times revenues.
So remember this. Remember back in 1999, 2000, we had TMT. That was the big thing, right? Telco, tech, telecom, media, and tech. So what obliterated those? Okay, the telcos all massively overspent on 3G and went almost bust. The tech companies, well, they had such an enormous bubble that created a huge problem for them. So the media companies that were interested, they got completely destroyed. And they got destroyed because, hey, guess what? Advertising spend is cyclical. And everybody thought it was secular. And we're going to go into the same situation again. And the two biggest media players in the world are, in fact, Facebook and Google. They are the advertising platforms of everything. And advertising is basically global GDP. So as global GDP contracts, advertising contracts, and their earnings get obliterated because it's 70% of both of their earnings.
But like the book value of the U.S. bank stocks, Raoul, what you're missing, because I know this company really well, is that it's a secular grower. It's a secular grower. It's, i.e. code for these companies have never seen a cycle. I mean, Zuckerberg's not even as old as when the last cycle happened. He wasn't even an adult, I don't think. I mean, for God's sakes, people think that these secular growers, again, these are the kinds of things that you hear.
And this is when I love the fight between macro and micro, right? Because there's some of the micro guys that I know. I love some of the micro guys are the smartest people I know.
Oh yeah,
great.
You got it.
When the cycle comes, most of the micro guys don't see it, and that's when macro dwarfs everything. So you might have a great company. Google may be a fantastic company, but guess what? It's going to look equally fantastic when it's down 65% on an advertising recession.
100% agree with it. I have to, because by mean reversion alone, since I had the lowest SAT score in my class at Yale, there's always a time where I get smarter on a relative basis than the smartest guy in the room. Captain Stock Picker, I have every 7 years, I kind of come out of nowhere with these macro calls. but just taking people back on this, just so that they see it if they haven't seen it. Slide 69, guys, we show the earnings cycle back in 1999, 2000. Not ironically, the earnings growth rate of the S&P 500 peaked at 22.9% in the third quarter, which was reported in the fourth. Cracks in the system, widening of spreads started happening well before that. But as Raoul just pointed out, it was led by comms and technology. What could possibly go wrong? I mean, only 4 quarters later, you can see earnings went from up 23 to down 13 to down 18. And all the smartest, I guess, Phi Beta Kappa Yale stock pickers ended up in the fetal position. So this is this is not for the faint of heart. And if you go back to the slide before that, which is not a log chart, the base of earnings, as I pointed out, go back to, there's 3 arrows there. Those are the prior 3 cycle tops that Raul's been, he's lived through. I think you've lived through 3, you're going into your 4th and mine my 3rd. But in 2000, was the earnings base, never mind the rate of change into the top, anywhere remotely close to the top right corner of this chart? Not even close. So the asymmetry, you would have to be the smartest person in the room, Raul, to say that you know precisely and you can calibrate day by day, month by month, how fast that line comes down and how everything reacts to it that's based on it. Earnings, the underlying, I guess Kudlow would call it the honeybee of credit or something like, this is the problem. People don't know. They don't know what they don't know yet.
Yeah, and I'm fascinated. There's a little known thing that people don't understand is in all of this, there's 2 issues. Is that credit, so when you're looking at those earnings, well, guess what happens when earnings go down is the corporate buybacks stop.
Yeah, good point.
Right, the corporate buybacks have been the largest single source of demand for equities in the world. In fact, all other sources of demand are negative now, except buybacks. So if you take buybacks away, okay, what do you do to the stock market? You create some enormous downside volatility. Okay, that's what happened in November, December. Super fascinating. The flip side of that is, okay, who's the buyer of all that corporate debt that the buybacks issue? That debt is bought by the pension system, primarily the bankrupt states such as Illinois, who have the big pension fund black holes. What they do is they've raised taxes to try and fill the black holes in their pension funds. Those tax receipts go into the pension system and buy this triple B corporate debt, which is starting to look more and more toxic. So it's this cycle that tax receipts are driving the buying of bonds, and it's the equity guys on the other side buying back their shares. Problem is both the tax receipts and the buybacks are all cyclical. So if the cycle falls any further, the buyer of bonds has left the building, of corporate bonds, and the buyer of equities has left the building. That's a huge problem.
Yeah, I mean, and by the way, it happens every single cycle. People can come up with their inside base. The best I like from Telecom Tom is the latest is the strategist being is that what you see is that during the Fed rate cut cycle, you get PE expansion. Now, that part of the statement's true. What Telecom Tom forgot to mention is that it's because the E completely cannonballs to the low end of where it could be. It doesn't mean the market went up. I mean, it's absurd. Like any cyclical thing, first it gets expensive and then it gets cheap all at once. But we're really at that point, and I think people forgot what you just said. I think they forgot that corporate boards, the CEOs, CFOs are scared of their own shadow. When their earnings are negative, they have less money to buy things back with, and then the board says, why don't we hold off a bit? I mean, go back and look at buybacks in 08, 09. I mean,
It's very forecastable. That's the stupid thing, right? It's not like it comes out of the blue. It's not a black swan. But everyone goes, oh my God, what happened to bond spreads? Well, they widened because the economy slowed, and everybody stopped buying bonds.
It came out of slide 68. There's never been a bigger bounty of corporate profits to buy your stock back with. And people say, oh, but that's because of Trump's tax reform. Well, Keith, that's part of it.
I know what they're going to do. They're going to look at that chart and say, well, Keith, you were wrong in 2015.
Yeah, even though I wasn't. I mean, it's still like, it's just like,
You know what I mean? They'll say, well, we would have seen a big cycle. They always go for that point They look for one outlier and go, well, why is it not that again? Yeah. Well, maybe it is, but I doubt it.
and now that we're communicating, by the way, my rate of change model came from analyzing companies. So instead of top line, I have GDP. Instead of margins or EBIT, I have inflation. So the more I get one-on-one with these guys, the better. It's getting better for me. I got to say, Raoul, it's I've gone from some people absolutely hating me and wanting me to get hit by a bus, and there are less buses. So I'd say, hey, the chances are going down.
I don't notice the hate mail so much. When I first bumped into you on Twitter, you'd be fighting all day with people. But people seem to respect you now. I don't know how you've won that over.
I think it's because of you. I mean, I think I think you helped me. I mean, I got to have some people that say I'm not completely bananas. Just a couple. Actually, I got to say, you're getting some compliments here. 30 years as a retail rep, Raoul. Yes, I'm old, but this is the best macro info I've ever seen. Honest, transparent, and data-driven. No feelings or opinion. That's cool.
That's nice.
Even though I think I have feelings. I mean,
I do, because he's basically suggesting I'm really old, and that's really pissed me off.
Oh, man. By the way, do you think you have to be old to do macro? Somebody asked me that the other day. In other words, they're asking it seriously. What we're finding, particularly with hedge fund, pension fund, mutual fund, institutional clients, is that the millennials are uniquely interested in this data-driven approach, and some of them are worried that they just haven't had enough reps. So, time does matter. Seeing more cycles does matter.
I've seen a few guys that I've got to know via Real Vision, young macro guys, and they're great because they are more data-driven than most of us were in the beginning of our careers. So that's really good. But, as you know, a lot of it is experience of knowing how it plays out. Mm-hmm. I mean, the reason I've had a good call on Eurodollars is because I've lived it twice before. Yep. Really, where I was actively involved in it. And right, I get this. I get that, this is the better trade. And so it's really difficult to learn those things without living it. So it does help. to have been around a bit. But also I think that we're probably undergoing unprecedented change in how the world works. So maybe our experience will be less applicable going forwards, and more people with an understanding purely of data, and even getting rid of our anchoring bias of how things can work, may be more successful in the future. I don't know.
Yeah, and I'm constantly on the lookout for that. I mean, I think it'd be an understatement to say that you have to evolve constantly as an investor, particularly if you're global macro in nature. I mean, if you don't change as the game is changing, you're just going to get run over by the game itself. And I think that's the biggest opportunity for younger people. It's hard for me to believe I'm 44 now, but when I was 33, I mean, I don't know 80, 90% of what I know now, and hopefully that's true when I'm 54 and 64 again and again and again, because I think that's really the opportunity, is that the game does change as the ecosystem changes. It'd be hard.
But that's why it's the beautiful game as well. Because you're always learning. It's not like you figure out how to solve the Rubik's Cube. No, this is the biggest 3D chess puzzle, biggest 3D puzzle of all time. Yep. So it's fantastic.
It's awesome. I love it. Last question on that, actually. The most interesting debate I've had with more than a few people that are engage in this type of debate are saying, what happens, and Jim Rickards really articulated well last week, what happens if what's already happening continues to happen? The Russians now have the most gold as a percentage of GDP out of any country. They're hoarding gold. Chinese are hoarding gold. They're going to partner up with the Iranians and the Turks, and they're going to have a new currency in the future state that is backed by blockchain and gold.
Keith, gold is not going to form a part of the global system because its scalability in the modern world is not as good. However, it has absolute value as a reserve asset, both at individual level and at country level and in any other way. So there's no distraction from gold. I'm very bullish gold. But I think that some sort of blockchain driven technology or something similar, I thought the Libra coin was incredibly interesting. Not that I have any care about whether Facebook managed to pull this off or not, I doubt it. But the point being is that global basket is kind of like an SDR, but issued by the private sector. I mean, that genie's out of the bottle now. That's an extraordinary thing, because it has dollars, yen, Korean won. It can have every currency in the world in it. So in which case it's entirely stable against everything except global money supply. So that's a huge change. I mean, why would you need anything else? So the revolution in money is coming, and does gold play a part of it? It always will. But will it be the future of everything? I doubt it. But the revolution, the future of money, is coming at us fast.
Yeah, I don't you and I aren't trying to write books on why to be long, blockchain or gold or whatever. I mean, we're just trying to, like you said, evolve and find where this fits within the game. And I just find that to be an interesting one, because
I think it's super important because both you and I were just talking about, okay, we know certain things are going to change dramatically in the future, and we kind of all have a suspicion, many of us macro guys have been around for a while, that the whole system of money, fiat money and stuff like that is probably going to change at the end of all of this because of the end of the global debt super cycle. So if that's the case, what are the outcomes? None of us know, but we all are trying to intellectually think it through, because then stuff like gold becomes a probabilistic bet on the future of a financial system. And so if the Japanese end up, for example, having a debt jubilee, buying the rest of their JGBs and writing them off, well, what do you want to be long in that situation? Well, you probably will be long some gold, because that's when somebody's messing around with money. Yeah, and if people are messing around with money, you want to be long gold.
And that's always been, the insecurity or the inspiration. I mean, two different words that start with I that mean completely different things. For people that are watching this conversation and trying to get to how it ends. And if it actually goes, God help us, if it actually goes down the path that you and I are talking about, then it eventually will end. There will be an end, and there'll be a new beginning, and that's just the way that the big phase transitions work. I sincerely appreciate you taking the time to have this discussion out in the open. I think that you just left the table open for many more, and and just looking at the feedback, I know that people would enjoy that. So you're always welcome here. I appreciate you spending the time. We also popped up a Recession Watch promo that you guys did for us. We really appreciate that. And for those of you that want to sign up,
not at all. If people go to realvision.com/Hedgeye, then there's a $1 for 3-month trial if they haven't got any of that. That's the website. So go and take advantage of it, because if you like macro and you want to hear people like Keith talk at length, in depth, and really to inspire you, it's the place to go. Because both a lot of Keith and my clients are all there talking about how they look at the world, and that's always great.
$1 for like 3 months when everybody's devaluing, that's worth a lot more than every day it's going to be worth more. I mean, it's just odd.
Yeah, that's ludicrous. And in this environment, honestly, you need to get information in this environment, because there is a lot, as I said, there's a shit ton going on. And for $1 for 3 months, that's a lot of ground coverage for, in a shit ton.
Yeah, indeed, there has been a lot going on in those words, and thank you for having the bravery to cover it. That was a real conversation with Raoul Pal. I had a lot of fun. Hopefully you did too, listening to it, and we'll look forward to the future ones.